Very good. Well, thank you for joining us today in regards to our presentation, Accelerate Cash with Qualified Improvement Property Deductions and More. My name is Ron Wainwright. I'm a partner and our national leader of credits and accounting methods at Cherry Becker. And my co-instructors today are two CAM team members, Don Poland, who is a senior manager on the credits and accounting methods team, as well as Sean O'Leary, who is a manager on the credits and accounting method team. So again, thank you for joining us today. Couple, I'll say, house orders as to the agenda that we want to cover today. You can advance the slide. And then next slide, please. So here are our speakers today. I've already done the introductions, but that way you can see us in person or at least by picture. So on the agenda today, we wanted to cover three very specific areas attributable to some recent IRS released revenue procedures, as well as a technical corrections that we saw within the CARE Act. So we will be covering qualified improvement property, often referred to as QIP. We want to go through some procedural considerations, specifically in regards to the Rev Procs 2020-25 as well as 2020-22. And then we also wanted to highlight related credit and planning options as we look to accelerate deductions attributable to QIP and other procedural considerations. So let me turn it over to one of my co-instructors, Don Poland, for the next slide.
Thank you, Ron. As many of you know, let me make sure that slide. I think sometimes I have to click it twice, so sorry about that. As many of you are probably aware, the CARES Act was able to push through the technical correction for the depreciable life of qualified improvement property. So with the Tax Cuts and Jobs Act that was a couple years ago, the life of this category of asset was accidentally left at 39 years when they intended it to be a 15-year life with bonus, which would allow for immediate expensing eligibility. So the change that came about recently with the CARES Act now allows this type of asset to be modified back to the 15-year class life retroactively to 1/1/2018. So there are many considerations for taxpayers at this juncture. The first is, how do we identify the QIP assets? And the second is, how do we correct previously placed in service assets? So first, let's discuss the question of identification. So basically, in the definition of QIP, this will encompass most of what you need to know in order to be able to determine if you have QIP or not. But of course, as we know, the devil is in the details. So let's talk about the specifics and the ins and outs in this definition. So qualified improvement property is only allowed for non-residential real estate improvements. This is going to include your retail plazas, your office spaces, etc. It's going to exclude your residential real estate, which is your apartments, your nursing homes, and your Airbnbs. It only includes 1250 property, which is real property. It excludes 1245 property, which is tangible personal property, which is your, essentially like your furnitures and fixtures. We'll talk about that in context of a building a little bit later in our presentation. So qualified improvement property is only allowed for modifications to the interior of a building. So if you are touching your exterior walls or anything on your roof, that's going to be excluded. So one of the specifically excluded items is the enlargement of a building. So when you think about it, in order to enlarge your building, you're going to have to mess with one of your exterior walls. So you're getting away from the interior. This all makes sense. So another rule is the improvement must be placed in service after the original building was placed in service. Hence the definition of improvement, it is not your original building. So it will never be allowed on any portion of your original building, your original purchase, etc. It's only after you've purchased and placed your building in service that you've done renovations. That's the intent of this definition. And then one of the items that was added to the definition by the CARES Act specifically was that the improvement must be made by the taxpayer. As we walk through our examples, you'll come to better understand why they added that piece of definition and how this works. So what I would encourage you to do is, as you're looking at your spend, come always back to this definition. When you look at what you have done to your building, and when you look at the definition, a lot of these things will pop out and you'll better understand where we're going with this, because the crux of what you need to know is encompassed right here. So let's walk through several examples, because this is always the best way to understand really what we mean by qualified improvement property. So let's look at a construction of a retail plaza. So We Love to Build LLC began construction on a 6-unit retail plaza in December of 2017. So in June of 2018, the anchor store opened for business. So when you have the first tenant go into a retail space, you generally have to have the shell of your building has to already have been issued a certificate of occupancy. So at this point in time, we consider that the building itself has gone into service because one anchor store was allowed to open and finished out and is now operating, and there's generating revenues from that business. So later in time, in November of 2018, 2 more retail spaces opened. We did the tenant build out for those 2 spaces, and in December, 4 more spaces opened. In this example, both of the spaces in November and December that were opened after the original building was placed in service are allowed for QIP treatment, as long as the spend and the renovations to those spaces was not excluded in any portion of that definition. All right, let's consider the purchase of a building. So in this case, we're not constructing, we're just purchasing a building. So we purchased an office complex in 2018. At that time, it was fully leased at the time of purchase. So we placed it in service immediately. One of the leases then expires, and we plan to renovate some portions of the building. Now, at this point, we've already placed our building in service ourselves as the taxpayer. Then we can, any renovations, and as our tenants flip over and we spend more money to renovate for new tenants, most all of that money will be allowed for QIP treatment, except, as we said before, as long as there's no excluded spend. That's a pretty easy example. Let's think about, though, in this context, because I've gotten this question before, that you purchased this building, but you had to renovate it before you actually put it into service. So, but this was an existing building. It had been placed in service by a previous taxpayer. If that's the case, all of your renovations can qualify for qualified improvement property, because the building was placed in service by another taxpayer previously, if that makes sense. So if your building was placed in service at another point in time, you're doing qualified improvement property, but to you, you're going to place it in service all at once because you're not actually generating revenues from the building later on. So there's a couple of different nuances to this, but as I said, if you read the definition carefully, it kind of makes sense. So let's say we purchased a restaurant. So fast food junkies purchased a burger joint location in a nearby city. The franchise had always been very profitable, so that tells us we know it's been placed in service previously. So the long-term plan is to renovate the dining area within the first year. So as we renovate the dining area, this will be allowed for QIP treatment. Now, what you need to consider for our restaurant was in 2017, at the end of 2017, when the Tax Cuts and Jobs Act came out, they got rid of the definition of qualified restaurant property, which previously had a 15-year life. Now that we have qualified improvement property definition in place, the definition of qualified restaurant property, qualified leasehold improvement property, and qualified retail property is gone. So the 15-year life given to those classifications of assets for buildings is gone. So no longer does a restaurant get 15-year property. You need to think about it in terms of it's now 39-year property, and all of your renovations, you need to make sure you can capture them at a 15-year life for QIP purposes only. All right, so now let's talk about Red Oak Apartments. So White Oak Construction Company began construction on a new apartment complex in January of 2018. In November, 5 buildings are ready to be occupied and are fully leased. The common areas also came online at this time. So in June of the following year, the remaining 3 buildings and 75 units are completed. So what's our QIP opportunity here? None, because QIP specifically excludes residential property. So we will never be able to take QIP on apartment complexes. Had this been non-residential commercial property, The 3 remaining buildings, we could have potentially grabbed some QIP out of that, but it just depends on the specifics. So our last example is Big Law LLC. So Big Law leases office space in a brand new building in Nashville. The building is newly constructed and is first placed in service in June 2018 when the first tenant moves in, who's a marketing firm, and they move into the 4th floor. So Big Law spends $500,000 to renovate their space and moves into the building. Now, note that Big Law paid for their own renovation. So they are not the owner of the building. They are just the tenant. But it was their spend, so they will depreciate their spend on their depreciation schedule. In that case, because they are the first tenants and the building itself has not been placed in service previously, this will not qualify for QIP spend even to Big Law. So in another city, Big Law has another office in Raleigh, and they are also going into a newly constructed building. However, they are not the first tenant to go into, I might have switched it, but if they are not the first tenant to go into the space, if another tenant moves into another floor, then they will be able to expense all of their spend, as long as it's not excluded, as QIP property, if that makes sense. So you do not have to be the owner of the building itself to be able to take QIP and say that the building itself or it was already placed in service previously to your renovation. All right, so what are our key takeaways from our slides and our examples? So one thing to remember is the placed in service date is a huge key. You can only rely on a prior owner's placed in service date for your initial renovations, but you cannot purchase existing QIP. So we've had many questions about this. So we talked about the fact that if you purchase a building that had been placed in service by another taxpayer, you bought the building from them, and then you did a renovation, you could say that a previous owner had placed this building in service, so your renovations were after that initial place in service date, even though you are placing the building in service all at one time after your renovations are complete. However, you cannot purchase a building that let's say your office space in our office example, that the previous taxpayer had completed QIP on, and call some of that purchase QIP to yourself, because you did not spend the money. So when we go back to the definition, the change made by the CARES Act, where they said that it had to be made by the taxpayer, that's what they're saying. You as the taxpayer have to spend the money for the QIP in order to get QIP treatment. That is a very key takeaway. The next thing to remember is if you happen to be on the ADS class life system, which is the alternative depreciation system, and you may be on this if you elected out of 163J, then your QIP gets a 20-year class life and you are not eligible for bonus depreciation. Okay, next I'm going to turn the mic over to Ron to help us understand our second question regarding how to correct our previously placed in service QIP.
Thank you, Dawn. So as we know from a legislative history perspective, the Tax Cuts Jobs Act unfortunately did not contain a correction in regards to treating qualified improvement property as 15-year and thus bonus eligible property. It was recognized that this was a technical drafting error and that QIP was inadvertently characterized as 39-year property ineligible for bonus depreciation. And so as commented, we know that on March 27th of 2020, under the CARES Act, it corrected this drafting error by treating QIP placed in service after December 31st, 2017 as bonus eligible 15-year property. So as a result, we have seen two revenue procedures that we will talk through today. So first of all, in regards to the retroactive correction, the IRS released Rev Proc 2025 so as to provide guidance allowing taxpayers to claim additional depreciation by amending their prior year returns and filing an automatic Form 3115, a la an application for change in accounting method. So when we think about how taxpayers can correct the qualified improvement as treated for 39-year property in their 18 and 19 returns that had previously been filed, What Rev Proc 2025 outlines to us is the procedural matters. So we now may amend that tax return with the corrections reflected for 18 and 19 and file those corrections prior to October 15th of 2021. With respect to filing an amended partnership return, those are due by September 2020, and that's per Rev Proc 2023. Now, remember that there is the partnership auditors regime, or you may file an administrative adjustment return by that time frame as well, from the standpoint of amending the partnership return is not possible. So if you do not have an opportunity to amend that, you may use the ARR as well. Now, the key here in 2025 is, of course, we are going to file a Form 3115 with the next timely filed return. That is an automatic change, and we are going to use the accounting method in our 3115 called DCN number 244. So note, this is a new DCN number that was outlined in the Rev Proc 2025 that now allows QIP changes to be made while waiving some of the traditional requirements other than the DCN number for a 2018, 19, or 2020 return. Next slide, please. So those are the procedural items that we want to make sure that we've covered with you in respect to that. Now, there's some additional options for corrections as well underneath the Rev Proc. So the Rev Proc also outlines other corresponding changes that could be made concurrently with a QIP life change from 39 to 15 years. So these include the following. We can make a late election to depreciate property using the alternative depreciation system method under 168G7, or we can elect out of applying the bonus depreciation to eligible property under 168K7, or revoke previous elections out to apply bonus depreciation. So Rev Proc 2025 procedurally covers a number of items. We can also elect the 50% bonus depreciation instead of 100% for the tax years encompassing September 27, 2017. This is pursuant to 168K10. So if you've not read Rev Proc 2025, we would certainly encourage you to do so, and certainly we're available for any other questions. So beyond Rev Proc 2025, which again provides taxpayers the ability to revoke a prior election out or make a late election on bonus depreciation, the service promulgated Rev Proc 2022, which then provides taxpayers with the ability to make or revoke a late election under 163J. So we know these items are intertwined. So again, this allows taxpayers to modify other elections that intersect or intertwine with the QIP life change on their current or prior filed return. So what can we do in Rev Proc 2022? So first, we may elect out of the 163J election that we previously made by amending that return where the election was first made. The second item we can do under Rev Proc 2022 is to elect out of the 50%, what's referred to as ATI limitation for 2019 and 2020. This election would, of course, apply the prior 30% rule when we think about the ATI calculation. Remember that partnerships only have this option for the 2020 year and not, and I do underline the word not, the 2019 year. So we've received many questions on this as well. Last, we may elect to use 2019's adjusted taxable income in a 2020 taxable year under IRC code 163J10 Cap B. Now, we're trying to give you the citations in the Rev Proc 2020-25 and 2020-22 because both of these Rev Procs are very complex and have a numerous procedural rules in them that we need to be paying attention to in our 2018, 19, and of course, 20 taxable years. Whether we amend or whether we file an application for change in accounting method, automatic, or whether we want to change our elections attributable to 163J, which we know is the interest expense limitation, whereby we elected to use ADS as opposed to accelerated depreciation and therefore qualify for bonus depreciation. Next slide, please.
Ron, can we pause here and address a couple of questions that have come in? And we also want to go ahead and get our first poll question in, because that was a lot of information to cover. So we did have a question come in that says, what about mixed use spaces? So if you've got residential on upper floors and commercial on the lower floor, does that mean the whole building is excluded from the QIP definition, or can the commercial spaces still qualify?
So it's a good question. There is a percentage test to any type of a multi-residential building when we think about the 80-20 rule. So that's more of a complex question than an easy answer. But the answer is we would need to evaluate the structure specifically in regards to the multi-use of the property underneath what's referred to as the 80-20 rule with respect to commercial property versus obviously multi-residential property.
Great. We had another question. What if the building, in the big law example, instead of leasing out a floor, what if the entire building gets leased by a firm moving into a new space? How might that apply?
So Dawn, in fairness to your example, you want to cover that, or would you like me?
I can cover that, Ron. That's fine. Thank you. In that case, if there is one tenant for the entire building, the building itself is going to be placed in service when that tenant moves in. So the definition of placing a building in service or a space in service to the IRS is when you start generating revenue. So when it becomes active technically in your business. So if you're the lessor, you're generating revenue on the building when your tenant moves in and you're starting to collect rent from them. If you're the business that's building out the tenant space, you have placed that in service when you actually move in, you start using the space for your business use. So if you are renovating and leasing the entire building, it's going to be placed in service at the same time the building is placed in service. So you are probably not going to have an opportunity for QIP in that initial build out.
Great. We've got one more question here. What if I buy a building that has not been placed in service yet? You know, it's just out of the developer's inventory. How would that count?
The initial building itself will not qualify for QIP because there's no improvement there. That's your initial building. You're placing that in service. Anything that you do after that. So let's say you move in and then even a week later you decide, you know, I want to redo the bathrooms, or I want to redo the lobby or whatnot, or I have a portion of my building I'm going to lease out to somebody else, so I'm going to build out that space. That's the type of improvements we're looking at for QIP. That initial original building itself, when you got it from the whoever you purchased it from, that will not qualify for qualified improvement property treatment.
Okay, one last question, Ron. Those revenue procedures seem to give us a lot of options and choices for compliance. Why is that, are all that flexibility so important right now?
Which really brings us to our next slide. So an excellent question, and that's one area that I wanted to highlight, is in the context of these determinations around QIP and knowing how it is intertwined or integrated into 163J, we have other and many tax positions that we need to be considering that are affected by these Rev Procs and this QIP chain underneath the CARES Act. So specifically, remember, we are changing potentially depreciation, and that is also included in our 263A cap calculations for inventory or UNICAP purposes. So we need to make sure as we're evaluating depreciation changes that we're taking that into consideration. Obviously, QIP, we're getting bonus depreciation on back in 18 and 19, but if we are making changes in our 163J calcs, we're going to have to make that determination in 263 Cap A. But to the question that was asked, which was a very good question. Thank you. Remember that we are in this CARES 3 provision where we say that losses that are generated now can be carried back 5 years. The reason that is so important, of course, is that, as we know, going backwards pre the Tax Cuts Jobs Act of 2017, we are looking at a permanent rate differential. And so we're going back and carrying back NOL back into rate arbitrage years. So losses that are generated now very much need to be scrutinized and calculated so we can carry back to a prior year to, again, help offset that higher tax rate. So the reason that they gave us the flexibility within 2025 and 2022 is specifically for this area, whereby we have the net operating loss carryback opportunity 5 years with respect to the NOL that is or could potentially be generated in the correction of the QIP, or as we're evaluating other areas from an accounting method perspective, as an example, in regards to developing or creating that net operating loss carryback. So again, if you've not had an opportunity to read the Rev Procs, would encourage you to do so. And certainly we're available post the webinar to answer any very specific questions. So next slide, please. I would say to you that we have some advantages within the CARES Act, as we know. So we want to make sure that we're considering the CARES Act to the question and all the changes in our 2019 business return, whether we're going to be amending 18 and 19, but filed returns or returns in process, make sure we're studying those specifically in regards to the Rev Proc and of course the QIP, as well as opportunities to ensure that we have maximized our losses through cost segregation study, fixed asset review analysis, which we'll talk about later. We certainly want to consider individual returns should be filed as soon as possible in regards to the CARES Act. And we certainly, to my point, want to review fixed asset additions for QIP after September 27, 2017, especially if we're going to make determinations around QIP. And then, of course, how will NOL changes ultimately, with the retroactive changes, free up losses in our analysis. Next slide. Okay, so this is a simple tool that we have developed to kind of help understand the QIP piece of things. Hopefully you can see that on the screen, as well as we can provide to you in one of our handouts. What we have developed is a qualified improvement part or property decision tree that would walk you through. So it's very important to highlight the red arrow, January 1, 2018 and forward with respect to the CARES Act, the retroactive treatment. Eligible for bonus, yes. 3-year rule, as we refer to it, no. And then 179 expensing is eligible. The answer is yes. In addition, some improvements that are disqualified from QIP treatment may qualify for Section 179 rule. So we don't want to overlook that opportunity as well. And remember that there is this hybrid of determination of place in service when we think about bonus depreciation rates. And we've outlined that as well here from a prior and then the tax reform perspective. The last item I will mention is a cash flow planning with qualified improvement property and depreciation. And that is a detailed analysis of approximately 5 pages with respect to a Cherry Becker external tax alert in regards to all of the considerations, as well as the flexibility to the question that was provided for not only in the technical corrections in CARE 3, but also the Rev Proc 2025, and then more importantly, 2022, with respect to allowing taxpayers to retroactively withdraw or make a late election under 163J for real property. So we talked about the importance of another takeaway and planning opportunity. I'd like to turn it back over to co-instructor Dawn, who's going to walk us through some related credits and also planning options as we get later into this presentation. So Dawn?
Dawn, before you get started, we're going to put up our next attendance poll question, and I'm going to go ahead and launch that and make sure that votes yes, so people can answer. If you missed the first one because it wasn't working properly, that's okay. Just make sure you answer the next three, and that's what counts. We need 75% on the poll, so 3 of the 4 polling questions. And for those of you who also put notes into the question pod, we have record of that as well. So if you're having issues with the polling question, then just please put a note in the question pod, and we'll have your name and record that you marked that as your attendance also. So that is, I think that is it. We haven't had any new questions come in on there, so we'll give this poll just another minute before you start talking about the advantages of using this new definition of qualified improvement property in connection with cost segregation studies and other tools. And that is good. We've got just another 5 or 6 seconds, and we will go from there. All right. I'm going to give you just another couple of seconds here, and we think we've got just about everybody who wanted to vote. So I'll close that poll and turn it back over to, let's see, yes. And Dawn, you're back live.
Yes. Thank you, Sarah, and thank you, Ron. I would like to say that we do really appreciate the questions, as Ron mentioned, and all of these items can get very tricky when you start interplaying them all in different scenarios. Feel free to reach out at any time to us, because we have dealt with almost every situation over time. So we totally understand the complexity. So please keep the questions coming. So what the first incentive and the planning opportunity that I want to talk about is cost segregation. Cost segregation is, as we know, a real estate asset, a building, must be capitalized as one building asset on your depreciation schedule. It's either going to have a class life of 39 years and depreciable, depreciated over that 39-year period if it's non-residential commercial property, or 27.5 years if it's commercial property. You're going to place it on your depreciation schedule with one place and service date, unless you've had a cost segregation study performed. And a cost segregation study, in essence, reverse engineers your building, breaks out every single component that you have, and takes your cost, your spend for that building, and assigns a dollar amount to every component. Once that is done, we can look at those components, and we look at IRS case law that says some of these components are really more in line with being like a furniture or fixture, like cabinetry, for example. And we can now depreciate that with a shorter tax life. So if you've had a cost segregation study done on your building, you're now allowed to put a portion of it in 5 years, 7 years, 15 years, etc. Once you do that on your depreciation schedule, you can immediately expense everything that falls into a class life lower than 20 years under the bonus depreciation rules. So that is a huge planning opportunity as far as being able to give you immediate cash flow in the form of reduced tax liability. So it's in essence a time value of money concept. You're taking a depreciation deduction right now instead of over the next 39 years, and you're being able to infuse that cash into your business where you need it most, instead of getting a little bit of a deduction from the government over a long period of time. And not even to think about the fact that most people do not hold buildings for that long period of time. So this is more of a deferral of tax concept. That's the time value of money concept that we're talking about. The other benefit that cost segregation gives to us is that we have the ability to go back in time and correct prior buildings that were placed in service, let's say 5 years ago. We can do a cost segregation study on those buildings, and that depreciation difference that you would have gotten in the last 5 years, we can pull all that forward, put it on your current year tax return, give you a big pop in deduction. You do not have to amend anything, and we do that only via a Form 3115. So this is another gift that the IRS gives us for cost segregation. So how do we identify where is the best opportunities to complete a cost segregation study? So if you have an existing building on your depreciation schedule, like we just said, you can go back in time and grab that. However, because we are talking about a time value of money concept, if that building is older than 15 years old, it's like a pendulum swing. Your pendulum is swinging now, back the wrong way. You're really not going to get the benefit from doing that study had you done it a little bit sooner. So anything on your depreciation schedule older than 15 years is probably not a good candidate for cost segregation. Obviously, if you've just recently purchased or just recently built a building, then that is a great opportunity for cost segregation because, as we talked about, you can't take QIP on a purchase or the actual new building itself. So the planning opportunity for those items is only in cost segregation. Now, if you've done a significant renovation, that is also, if you've done like expanded your building or you've made major changes that are going to be excluded from the definition of QIP, that is where you want to look to a cost segregation study as well. So these are the typical reclassification results that we see when we do studies. These percentages represent that portion of your building cost that we generally see being brought down into short life and immediately expensed. So when you see like a hotel is 25 to 45%, what we're saying is 25% of the cost of your building can be immediately expensed in year one. The impact is huge on your bottom line tax liability. So how do we communicate value to our clients? Well, we help our clients understand that no depreciation is bad because you do want some reduction in your taxable income when you have a big cash outlay for a building. Obviously, some depreciation is good. That's what the IRS gives you without a study, little drips of depreciation over a long period of time, but more depreciation is better. And then you just have to think about that time value of money concept. So one of the things to think about when we do cost segregation studies is what could you do that could be better to better use that dollar. So it is all about the ROI. When you talk to us about potentially doing a study on your building, we will give you that return on your investment. Studies are not quick and easy. They do actually take a lot of time. We have to visit the site. We have to follow a lot of IRS guidelines. So we give you what we think is going to be your benefit for your spend to do the study. So it is a win-win situation because we give you that example and your ROI at no cost so that you then can decide whether it's going to be worth it for you. So let's talk about how cost segregation and QIP can work together. So when we do a cost segregation study on a building, so let's say that we have that retail plaza example that we initially was our very first example. We would identify in the cost segregation study those pieces that are now going to qualify in your spend for your tenant build out, for example, as QIP. So you're going to have all of the answers. We give it to you on a depreciation schedule that you can hand to your accountant and go ahead and say, they have already vetted this. This is what qualifies for QIP. This is what doesn't. This is what can go into short life. Remember in our definition of QIP, they had a specific carve out that QIP is only for 1250 property. That is your real estate property. 1245 property, which is excluded, is actually what it would be excluded in a cost segregation study. So when we do a cost segregation study on a building, we're going to first take out that 1245 property. That is going to be already excluded from your QIP. So then we would identify what's left behind as 1250 property that qualifies as QIP for you. You have now an IRS-ready packet that shows the IRS you have done all of your homework and all the positions that you've taken follow all the IRS guidelines. The other thing that you need to think about when you're doing QIP and cost segregation together is that if you do have some excluded structural items in your spend, we can properly determine the breakout between those two things. And it isn't always readily apparent. I will say that one of the things that I hear is that, for example, when people do construct a brand new building, they have their general contractor, they have their pay app, and that pay app says there was X amount of money for site work, there was X amount of money for concrete. They think they don't need a cost segregation study because they can just take those numbers and put them on their depreciation schedule. Well, that is not the case. I will say that your results from the cost segregation study will be quite different, and there's several reasons for that. And one of them is you have to properly allocate all of your soft costs to all of your hard costs, which is not done on your pay app at all. When we are looking at QIP and excluding structural items and then also including the other items, your numbers will come out differently for this very reason too. So it is it is good to realize that you do need to kind of go about it the right way, because if the IRS comes knocking at your door, you need to be able to prove that you have followed their guidelines in taking your position. So now I would like to turn it over to Sean, who is going to talk to us about our next planning opportunity.
Before Sean begins, I'm going to bring up our next poll, and I hope this one works better than the last. We'll go ahead and put that out there for you to mark your attendance. This is the third of 4. Great.
And everyone, make sure you answer the poll in the polling question. So you just click your response on the radio dial. Just click yes. Make sure you're answering in the poll and not in the chat.
Sean?
Hi, yes, good afternoon.
I think we might want to just continue. I'm not sure if the poll got stuck, but I think it'd probably be a good idea to continue with and then we can do the TPE credit behind the scenes.
Okay.
Yeah, let's do that. Sean, please continue starting at slide 28.
Okay, thank you. Thanks, Ron and Dawn. Good afternoon, everyone. Today I'm going to talk about some specific tax credits and deductions that relate to energy efficiency and how they apply to the dollars spent on buildings and building improvements that many taxpayers make on a regular basis. This past December, President Trump signed some extender bills that reinstated some very important energy-related incentives. So now is a great time to discuss them and how you might be able to use them to reduce your tax liability. Specifically, the Section 179 Cap D energy efficient commercial buildings deduction and the Section 45L new energy efficient home credit were two incentives that had expired for the 18 and 19 years. So taxpayers were unable to claim them for 2018 and were unsure if they would be able to take them for the 2019 year. However, as I mentioned this past December, these two provisions were put back into the tax code retroactively for 2018 and to include both tax years 19 and 20 as well. Thus, we now have the ability to capture these incentives for buildings placed in service through the 2020 year. Today, we are going to review some of the specifics of these incentives and how they benefit you. Could you go back one slide, please? The Section 179 Cap D energy efficient commercial buildings deduction provides an incentive for taxpayers and government entities to design and build energy efficient commercial buildings. For taxpayers, the incentive is a potential $1.80 per square foot deduction against taxable income. Thus, a 100,000 square foot new building could produce an immediate deduction of $180,000 in the year the building or improvement is placed in service. The $1.80 per square foot deduction is broken down into three components, each of which is 60 cents per square foot for the energy efficiency of the HVAC system, the lighting system, and the building envelope, which is the roof, the doors, windows, insulation, and other building components. It is possible to receive a partial deduction for either one, two, or all three of these basic components. Thus, for the 100,000 square foot building I mentioned, it might be possible for a taxpayer to just claim the energy efficient design of the HVAC system and claim a $60,000 deduction. There are two types of Section 179 Cap D studies, one where the taxpayer owns the building or improvement, and another for government-owned buildings where there's a special provision that allows the architect or engineering firm that created the energy efficient specifications to receive a transfer of the deduction from the government entity that owns the building and deduct it on their own return. Okay, next slide, please. So what exactly are we deducting? For the situation where the taxpayer owns the building, the full deduction is taken in the year it was placed in service, and it also reduces the building's basis, which does result in a small reduction of the yearly depreciation expense over the life of the building. Also, due to how the 179 Cap D deduction is reported on tax returns, it is possible to take the deduction on a current year return, i.e. 2019, even though the building may have been placed in service many years ago. This is a great feature that you may want to consider as it provides the benefit of the 179D deduction on your current year return without the hassle of having to go back and amend returns for older buildings. Each situation is different, and this approach may not make sense for very old buildings whose remaining depreciable basis is low. Okay, next slide, please. Here's an example of a 179 Cap D project for a building owned by the fictional Midtown Apartments partnership that was placed in service back in 2017. The total cost of the building was almost $22 million, and a cost segregation was done that allocated nearly $6 million to the 5 and 15-year depreciable lives that were given bonus treatment, leaving $15.8 million left over as the 27.5-year asset for real property. A Section 179 Cap D study was done that fully qualified the 52,000 square foot building, producing a $93,744 deduction, which is immediately expensed, leaving a net $15.76 million to be depreciated over 27.5 years. Thus, Section 179 Cap D allows you to expense immediately a portion of your long life asset, and then the remaining building asset is reduced. Essentially, this works similar to bonus depreciation and a cost seg study, but is applied to the real property asset. We should point out that the net benefit for the taxpayer-owned building is typically less for doing a 179D study than it is for a cost seg study. So the building has to be big enough to justify the extra cost of certification. As you can see in this example, the cost seg generated an accelerated expense of around $6 million, whereas the Section 179 Cap D study produced about $94K and it accelerated deductions. Okay, next slide, please. The 179 Cap D program has a special provision for buildings owned by government entities that allow the architect or engineering firm that created the energy efficient specifications to be assigned the deduction from the building's owner, since they are non-tax-paying entities. The governmental entity can sign a form that transfers deduction over to the architect or engineering firm that did the design, and in some cases, multiple firms can share in the deduction for performing different roles. The government owner has ultimate responsibility to decide how much each designer receives. As they note, many construction firms attempt to claim this deduction, but it's important to be aware that only the primary designer of the energy efficient specifications can claim the deduction. For government-owned buildings, the deduction is claimed as another deduction on the tax return with no reduction in any other asset, and for older buildings, it's claimed via an amended return. Lastly, we should point out that for government-owned buildings, there's an extra layer of complexity since the taxpayer will need to secure the government signature on a form that allows them to take the deduction on their return. In both situations, whether it's a government-owned building or whether the building is taxpayer-owned, the taxpayer must engage an unrelated third party to perform an energy certification prior to claiming deduction. This third-party certification is a role that we and our engineers frequently provide to our clients. Next slide, please. So who can claim so who can benefit by using the 179 Cap D deduction? The main things you want to consider are situations where you have built or improved a commercial building that is at least 100,000 square foot, or have leased the building and paid for improvements to either the lighting, HVAC system, or building envelope. As noted here on the slide here, if it is a residential building, then it must be at least 4 stories tall. And again, if you are an architect or engineer that is in the business of designing energy efficient buildings for government entities, you should discuss those properties with, you should discuss them about the 179 Cap D program. Lastly, the 179 Cap D deduction is based on the energy efficiency of HVAC, lighting, and building envelope components of a commercial building. Okay, next slide, please. Okay, on to the Section 45L credit. The Code Section 45L New Energy Efficient Home Credit provides a credit of up to $2,000 for each home or apartment that is substantially completed prior to December 31st of this year. This credit is available for apartments, townhomes, condos, single-family homes, assisted living facilities, and even student housing, as long as there are no more than 3 floors above ground. The 45L credit is claimed by the taxpayer that builds the property, whether it is an individual residence or a unit of an apartment building, and must meet certain requirements in the material specifications of the doors, windows, roofing materials, HVAC systems, and other components. Also, note from an accounting standpoint, the credit will reduce the taxpayer's basis in the property. So, for example, a builder or developer claiming the credit would have to reduce either its cost of goods sold deduction or its depreciable basis in the amount of the credit taken, depending on whether they build the apartments to sell to another entity or they are leasing them directly. Next slide. As I mentioned, the credit is $2,000 per qualifying unit. A qualifying unit is one that is certified to have an annual heating and cooling consumption of 50% or less as compared to a comparable dwelling unit defined by an energy efficient standard. There is also a credit of $1,000 per home for manufactured homes that satisfy a slightly lesser standard. The credit is taken in the year the unit is sold or rented, and can be taken in prior years by amending returns going back no more than 3 years. Similar to the Section 179 Cap D deduction, the Section 45L credit requires certification by an independent third party in order to claim the credit. Next slide. Here's an example of a 45L credit project for a hypothetical 300-unit apartment complex, say in Augusta, Georgia, for which all of the units passed and was awarded a total credit of $600,000. Each unit is tested separately and determined to pass or fail. In this case, each unit passed and was awarded a certificate like the one shown here in the slide. The Section 45L credit is largely determined by the SEER ratings of the HVAC and heating systems, as well as by the type of insulation material and the design of the doors, windows, and other materials used in the construction. It is usually somewhat difficult to receive this certification, so it's important to evaluate the units with your tax advisor prior to beginning the certification process. Next slide. So how do these incentives interplay? And can we take all 3 incentives on the same building? But before we get to that, let's recap our choices. Cost segregation is an acceleration of a deduction and allows immediate expensing of a portion of the total building's cost in lieu of depreciation. It's a time value of money play and puts cash back into the pockets of the building's owner in the form of tax savings. Similar to cost seg, 179 Cap D is also an acceleration of the deduction. It's another form of reclassing a part of the building out of a long-lived asset into an immediate deduction. On the other hand, Section 45L is a pure tax credit that reduces your tax liability dollar for dollar and has nothing to do with depreciation, even though the depreciable basis is reduced by the credit. So let's look at when each incentive can be used. Next slide, please. Cost segregation can be used with either 45L or 179D, although 45L can only be used by the taxpayer that pays to have the building built and they must either sell it or rent it out to others, whereas 179 Cap D, similar to cost seg, is used specifically by the building owner. Both 45L and 179 Cap D cannot be used on the same project. 179 Cap D is typically only used for commercial buildings, whereas 45L is used for residential real estate. So the only time you would ever consider all three is on residential real estate. The differentiator is how tall the building is. If it's 3 stories or less, then 45L is used, and if it's 4 stories or more, then Section 179 Cap D is used. Let's look at an example. Next slide, please. So let's examine a fictional apartment project in North Carolina that has 14 3- and 4-story buildings that had a total of around 178,000 total square feet across 280 units. A cost segregation study was done that segregated 25% of the building's total cost into short-term assets and produced around $5.8 million that could be immediately expensed in the year placed in service and produced a tax savings of around $2.3 million. Of course, the remaining portion of the building, or about $19.2 million, is then depreciated over 27.5 years for tax purposes. So after the cost seg is done, do we take 45L or Section 179 Cap D on the remaining 19.2 depreciable basis or long life depreciable basis? Well, the 45L can only be used on buildings that are 3 stories or less above grade, and the credit for those buildings is determined on a unit-by-unit analysis and certification. So some of the units will qualify and possibly some will not, although remember that the energy efficient standard for 45L was developed back in 2005, so there's a good chance that they will. For the buildings that are 4 stories or more, we can consider 179 Cap D on the total square footage of those buildings, but again, these will also require an energy certification. In the case of 179 Cap D, the standard in place is from 2007, so most buildings usually do qualify. Lastly, we want to point out that both Section 179 Cap D and 45L projects require an energy efficient certification that must be done by a qualified engineer or contractor, and you should also consult with your tax advisor to ensure proper reporting adherence to special rules for these incentives. Next slide, please. Okay, that's it for energy incentives that we wanted to discuss today. Thank you for listening this afternoon, and now I'm going to turn it back over to Ron to wrap up. Thank you.
All right, before we get there, Ron, let's go ahead and launch the last poll question so that we can get the last of the CPE credits recorded as you start to wrap up your last comments, final comments. All right, we've got just another couple of seconds here to record your last attendance here. And we'll give it just about another 15 more seconds for people to put a final vote in to record their CPE. And all right, I'll go ahead and close this, and Ron, let you go ahead and wrap up.
Very good. Thank you, Sarah. So just to summarize quickly before we get into some additional credit for consideration. So when you think about the qualified improvement property, when you think about the cost segregation, and then what Sean covered in 179 Cap D and 45L, remember that QIP is a retroactive adjustment to 1819, very similar to 179 Cap D and 45L. That was part of the December 2019 technical corrections bill. So CARES Act 3 brought in QIP, as we know, retroactive. When we think about other credit opportunities, when we're dealing with either real property or other types of property, remember the historic rehabilitation tax credit is there from the standpoint of a certified historical structure, significant opportunity. And then more importantly, a financing mechanism. And we have a group within Cherry Becker, Tax Advantage Group, one of the premier groups in the country in regards to new markets tax credit. So to the extent that a property is either being developed within one of the zones, as they're referred to, in regards to new market tax credits, there is also an opportunity there as well. So very important not to overlook those credits. There's 165 credits in the statute, as we know. New markets tax credit, again, a financing mechanism. Historic rehabilitation tax credit, similar to solar credits, et cetera, as other credits within the statute. So next slide, please. So here are our contact information. We're about at the top of the hour, a little bit over. To the extent you may have any questions for members of the Credits and Accounting Methods team, myself, Ron Wainwright, as well as Don Poland or Sean O'Leary, our emails are here. Please feel free to reach out to us. As we know, we went through some complex areas with respect to the Rev Proc, as well as the intertwining or the integration of not only QIP, but 163J, as well as Cost Seg, 179, et cetera. So on behalf of Cherry Becker, we want to thank you for attending today. You will be receiving CPE credit, and have a great day, as well as be safe and be healthy. And so thank you is our last slide, and we hope to hear from you if you have any questions at all. So thank you and have a great day.
Thanks everyone for joining us today. As long